So hey guys, welcome back to new lecture of our LFX mentorship series. And sorry I'm a bit late. And in this lecture we are going to talk about fair value gaps and how to actually read market structure using fair value gap. See, I am not teaching you how to trade. I will teach you this when you will be at a level when you know everything. Okay, so don't have a FOMO to get rich quick, get into the markets early. First, understand everything deeply and apply them on the charts. And as your level increases, I will teach you how to trade. I will actually give you my whole system so you can trade with that. Okay, so yeah, without wasting any time, let's begin. So I am going to talk about this fair value gap. So basically there are two major types of fair value gap: bullish fair value gap and bearish fair value gap. First, you have to understand what a fair value gap is. So a fair value gap is basically an imbalance in price. Okay, a fair value gap is an imbalance in price, and it is a three candle pattern. Okay, it basically forms by only three candles. Okay, so a fair value gap is an imbalance and it is formed by three candle patterns, and it acts as a magnet for price. A fair value gap acts as a magnet for price. So these are the three things which explains a fair value gap. Okay, so once again, a fair value gap is an imbalance in price. It is a three candle pattern and it acts as a magnet for price. Make sure you are taking notes of it. So how to actually identify it? So you can see this is one candle, this is second candle, and this is third candle. So the wicks of candle number 1 and candle number 3 have a gap in between. See this, they have a gap in between. The wicks are not touching like this. Okay, if the wicks are touching like this, there is no gap, so there is no imbalance, and hence there is no fair value gap. But if the wicks are like this, so you can see there is a gap in between like this. Okay, there is a gap in between the candles, so this is a fair value gap, and the market is moving up, so this is the example of bullish fair value gap. Okay, so now what is a bearish fair value gap? uh, as you all know, it is a three candlestick pattern. The wicks of the first candle and the wicks of the third candle, if they not meet together, then there is an imbalance, and this imbalance is just known as fair value gap. So here is the wick of first candle and here is the wick of third candle. You can see they are not meeting, so this is a example of fair value gap and the market is moving down. So this is an example of bearish fair value gap. So once again, in easy language, fair value gap is equal to imbalance in price. Now imagine if the candles are like this. If the candles are like this, okay, if the candles are like this, so the wick of the first candle is here and the wick of the second candle is here. So you can see, is there any gap in between? No. So if there is no gap, then there will be no fair value gap. Okay, and if there is also a tiny gap like this, then it is also a fair value gap. No matter how small the gap is, it is a fair value gap. But if the gap is like this very tiny gap, then usually don't take that. It is not considered as a great fair value gap. But if the gap is visible without zooming in, then it is a valid fair value gap. So now you have successfully understood what a fair value gap is, and now I'm going to show you some examples on the charts. So first you start from bullish fair value gap. See this market, start from here. See, it is a three candlestick pattern. Okay, so are you seeing any fair value gap here? See, this is the first candle. Okay, this is the second candle and this is the third candle. So I'm going to mark now the wick of the first candle and the wick of the second candle. See, there is no wick here. Okay, if there is no wick, then just take the body. So this is an imbalance. Okay, and if we extend this is a fair value gap. Okay, and the market is moving up, so this is a bullish fair value gap. So this is a bullish fair value gap. You can see how easy it is to mark fair value gaps. Now as we move up, you can see this is the first candle, this is the second candle, and this is the third candle. So is there any gap between them? Yes, there is a gap. So this is a bullish fair value gap. Okay, and you can also see here, this is the first candle, this is the second candle, and this is the third candle. So first candle body plus second candle wick, it also forms an imbalance. And when these two imbalance met, then usually mix them both and just mark the whole area, so it works as more efficiently. And then as we move up, you can see how massive fair value gap here is. This is the first candle, this is the second candle, and this is the third candle. Wick of the first candle, wick of the second candle. Here is a gap, and this is a fair value gap. And then as we move up, this is the first candle, this is the second candle, this is the third candle. So first candle wicks, second candle wicks, this is a bullish fair value gap. Then as we move up, see there, this is the first candle, this is the second candle, this is the third candle. So wick of first candle plus wick of third candle. Is there any gap? Yes, here is a fair value gap. Now as we move up, this is the first candle, this is the second candle, and this is the third candle. So see, is there any gap between the first and third candle? This is the wick of first candle, this is the wick of third candle. No, there is not any gap here, so there will be no fair value gaps. And as we move up, you can see this is all chopping around and there is no fair value gap, but there are fair value gaps that we have marked like 1, 2, 3, 4. So you have now understood how to identify bullish fair value gaps, and now take some examples of bearish fair value gaps. So yeah, let's see here. Start from here. This is the first candle, this is the second candle, this is the third candle. So wick of the first candle plus wick of the third candle. Is there any gap in between? Yes. So this is a fair value gap and the market is moving down, so this is a bearish fair value gap. Okay, then is there any fair value gap? No. And here no fair value gaps. It's all choppiness of the market. And when you see here, wick of the first candle, wick of the third candle, this is a fair value gap. This, and the market is moving down, so this is a bearish fair value gap. And when you move here, you can see 1, 2, 3. Okay, this is the first candle, this is the third candle. Is there any gap? Yes, there is a gap, so this is a bearish fair value gap. Then again, wick of the first candle, wick of the third candle. Any gap in between? Yes, so this is a fair value gap. So you have now understood how to mark bullish fair value gaps and bearish fair value gaps. Now I am going to explain you how to actually read market structure using the fair value gaps. So as I have already taught you all that how markets move in the market structure video. So markets move like this. A bullish markets move like this and a bearish markets move like this. Okay, a bullish market move like this and a bearish market move like this. So a market doesn't move in a straight line. Okay, it moves with healthy retracements. So how can you tell that from which point or which level the market is going to reverse? See, if the market is in an uptrend, it moved till here, then it wants a retracement. So when it is doing this retracement, then how can you tell that from which point the market will end its retracement and continue its trend? So we identify it by using fair value gaps. So usually the leg which is in the favor of the trend of the market, usually has a fair value gap, and when the market comes in the fair value gap, it reverses. Again, this leg must has a fair value gap, and when the markets come, it just reverses. So like this, you have to use the fair value gaps to identify your market structure. If it is a bullish market structure, it moves like this: healthy retracement, market goes into a fair value gap, then reverses. Then once it expands, again a healthy retracement comes, it goes into a fair value gap and then expands. Then healthy retracement, it moves into a fair value gap and then again expands. So this is an example of bullish market structure. And now I am going to show you an example of bearish market structure. So when the market is moving down, there must be a fair value gap like this in here, and the market will come into this and reject off. And when the market is going for a retracement, there must be a fair value gap and market comes into this and rejects off. And like this also here, market comes into this and reject off. So the fair value gap is the key concept of all the things in my strategy. And now you have understood what a fair value gap is, how to identify it. Now we are going to deep dive into how to actually read the markets using fair value gaps. But before moving into that, I have to explain you one more thing. Like, if the market is moving like this, okay, so when a fair value gap gets respected like this, the market will continue moving in the favorable direction. Means if the market is in a bullish trend, then it will continue moving in a bullish trend. But imagine here is a fair value gap like this, and the market comes into this fair value gap and disrespected this, okay, then the market is going to reverse. Forgot the break of structure, forgot the change of character. That was the basic thing. I explained it to you uh, for your knowledge, but you don't have to use that. You have to use only fair value gaps. So once again, this is example for the bullish structure, and I will explain you now bearish structure. Like if the market is moving like this, if there is a bearish fair value gap, and then the market comes into this and it respects it, then it will continue moving down. But if the market comes and disrespects it, means inverse it, then the market is going to reverse. You may have a confusion in inversion of fair value gap, so I am going to explain it to you now. So suppose the market is moving down and here is a bearish fair value gap, so we will mark the bearish fair value gap, okay. And wait, let me change the color. And here is a bearish fair value gap, and when the next candle opens here, it goes all the way up and it disrespects or fills the fair value gap or inverses the fair value gap. The inversion of fair value gap means the candle closes above or below the fair value gap. The candle closes above or below the fair value gap. If the market is in a downtrend and it closes above the fair value gap, then the trend is likely to change. Or the market, when it is in an uptrend and it closes below the fair value gap, then the trend is going to change. So here the market is in a downtrend and the candle closes above the fair value gap, then the market is going to move like this, okay, and vice versa for the bullish side. If the market closes below the fair value gap, then the market is going to move down. When the market does this, it disrespects the fair value gap. We call this as IFVG or inversion fair value gap. Means the fair value gap got inversed. Okay. So this tells that the market is going to change its direction. In the market structures video, I have taught you that if the market is moving in a downtrend and it closes above its swing high, then this is a market structure shift, and then the market is going to move in the opposite direction. But you don't have to see this swing high, you just have to mark the fair value gap in this leg, and if the market disrespects it, then it will continue moving higher. Okay, so in a short language, inversion fair value gap is equal to market structure shift. This is all. Okay, so now you have successfully understood about the fair value gaps, how to identify it, and the inversion fair value gaps. Now I am going to tell you how to actually read the markets using the fair value gaps. So let's start from here. We will start after this line. Okay, so in this leg, do you see any fair value gap? If there are some consecutive fair value gap, mark them as a one fair value gap. Like this is the first candle, this is the third candle, here is a fair value gap, and is this a bullish fair value gap or a bearish fair value gap? The market is moving down, so this is the bearish fair value gap, and here is also a bearish fair value gap, here is also a bearish fair value gap, and here is also a bearish fair value gap, and here is also a bearish fair value gap. So if the fair value gaps are very close, okay, if the fair value gaps are very close, then if you see them on the higher time frame, it will act as a one fair value gap. If you see this structure on the 15-minute, you can see this is only a one fair value gap. So if there are consecutive fair value gap, mark them as only one fair value gap. Okay, so we were here, there are some consecutive fair value gaps, so I'm going to mark them as only one fair value gap. So extend it from here to here. Okay, now if this is a bearish fair value gap and the market goes into it, then if the market respects it, the market will start to move down, or if the market disrespects it or inverses it, then the market is going to move up. Then you can see the market respects it. Okay, market respects it and start to move down, so this fair value gap is valid. And as the market starts moving down, it generates this fair value gap, and as we move down, is there any fair value gap? No, yes, here is a fair value gap. You can see this is a fair value gap, and if the market is going to inverse it, then the market is going to move up, and if the market is going to respect it, then the market is going to move down. See, the market can wick the candles above it, but I have already told you, you have to wait for the closing of the candle. If the market didn't close it, then the market is going to respect it. If the bullish candle comes till here but it didn't inverse this, then this value gap has not inversed yet. But if this value gap has got just inversed by a pip, then the market is going to change its direction. Okay, this is how powerful a value gap is. Now this value gap got respected, the market starts to move down, and now you see, is there any value gap in this leg? Yes, see this value gap, and we have also a second value gap, so we can just mark it here, and see, here is also a value gap, but I have to zoom in to actually mark this. So don't mark the value gaps which need you to zoom further in to identify them, but this is a valid and nice movement. So this gap is actually visible from far away, so this is a nice value gap, and the market is moving down, so this is a bearish value gap. So when you extend it, okay, you can see the first market respects it. Okay, first market respects it and then comes and disrespects it. Okay, first the market respects it and then come and disrespects it. Now here is a sign that the market is likely to change its direction, and you can see the market has started moving up. So this is how easy trading really is. Just you have to know the key concepts, and yeah, now let's go and dive further into it. So this got disrespected around here. And is there any bullish value gap in this leg? Here is one value gap, you can see here. This is a bit volatile market, so there may be gaps like this, but this is the first candle. Here is no wick, here is a body. This is the second candle, and this is the third candle. So here is an imbalance. So this is a bullish value gap. Now just extend it. Okay, this is also visible from this. Okay, but this gap is not that visible, so I haven't took this, but I have take this. So if we extend it, you can see how nicely the market respects it and rejects from it. You can see. Okay, so you have now understood how the market moves using value gaps. And one more thing, you can see that here is also a value gap. So let me mark this. See, the market comes into this and rejects. Okay, then it start moving higher, 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 and then here's a value gap, here's a value gap. The market comes and rejects. Then here is a value gap. The market comes and rejects. Then here is a value gap. The market comes and disrespects it. This value gap also market disrespect this, but it got respected from this value gap. Okay, so if there are suppose 1 2 3 value gaps, if the market disrespect the first one, disrespect the second one, it may get respected from the third one. Otherwise, if the market also disrespect the third one, then it will likely to change its direction until the next value gap is there. See, the next value gap is here. Okay, and when the market disrespect this one, it got respected from this one. Okay, so this is how you read market structure. I know that it is a little bit confusing, but as you go on the charts and see this happening, it is going to become a piece of cake for you. So this is all I am going to teach you in this lecture. Otherwise the lecture may become long, and I have pretty much told you everything about value gaps. And the next video I am going to talk about liquidity, so it will come in likely 2 to 3 days. And the homework for today's lecture is that go on the charts, go on the 5 minute time frame, and see how market moves. Okay, draw at least 100 to 500 value gaps. Okay, and see just how market respects it and how market disrespects it. Okay, you are going to be shocked at how market moves using value gaps. So that's all for today's lecture. I hope you enjoyed and understood everything very well. Until we meet again, be safe.